A bowl of rice, chicken, and hummus. Average price $16. At its peak valuation, Wall Street priced each CAVA location at nearly $30 million. That means investors believed one lunch line could produce venture capital returns, and for a while, the stock agreed.
Look at this, because shares of CAVA, they are surging just this morning again, and they're up more than 400%. You ready for this? From last year.
Then the math stopped working.
Out there right now for the restaurants, Dom. So as you said, CAVA reporting EPS and revenues right in line, but it did miss on those same-store sales estimates. They were up.
In late 2024, CAVA hit $150 per share. With 367 restaurants, the market valued each location at nearly $30 million, double what the market assigned to Chipotle locations. Wall Street wasn't just betting on CAVA, they were betting on inevitability. By summer 2025, that bet was falling apart. Chili's was winning with sit-down meals for under $11. Business writers had a term for what was happening: slop bowl fatigue. Every fast casual chain selling the same stuff in different bowls. The format had commoditized. CAVA's stock collapsed from $150 to the low 60s. 60% evaporated in months. What broke wasn't the food, it was the assumptions. Traffic growth decelerated across major urban markets. Same-store sales momentum cooled. The repeat frequency of loyalty members softened. And when frequency drops in a high-frequency lunch concept, the model starts to strain. This is the story of how a lunch bowl collided with a $10 billion narrative, and how management watched it crack without flinching. To understand why investors lost their minds over a hummus company, you need to understand the psychological trick that fast casual pulls on your brain. The model is simple and devastatingly effective. Take the speed of a drive-thru, combine it with ingredients that look like they came from a real kitchen, put it all behind a glass counter, and let the customer assemble their own meal. That last part is everything. You're not being handed a number 7 combo by someone who won't make eye contact. You're building something. You're making choices. And because you feel in control, you don't notice you just paid $16 for rice and vegetables. Chipotle cracked the code with burritos. Sweetgreen tried it with salads. CAVA applied it to Mediterranean food, a cuisine that markets itself. Nobody needs convincing that hummus and grilled chicken beats a Big Mac. The food sells itself. But CAVA had a secret weapon the others didn't: the dips. Crazy feta, harissa, tzatziki. These weren't condiments, they were personality traits for a certain type of urban professional. Ordering crazy feta said something about you. It said you cared about flavor, that you were adventurous, that you had $16 to drop on lunch on a random Wednesday. And once your condiment becomes a cultural signal, you're not a restaurant anymore, you're a brand, and brands get a premium. So when CAVA went public in June 2023, the pitch was intoxicating. Mediterranean food, fastest growing cuisine in America. The addressable market, tens of millions of health-conscious millennials. Digital loyalty, off the charts. The company wasn't selling bowls, it was selling a platform. The IPO priced at $22, it doubled on day one, closing near $44, instant $5 billion valuation. Investors weren't buying a restaurant chain, they were buying a growth story with unlimited runway. And in markets, a compelling growth story can override uncomfortable math for longer than most investors expect. Until it can't. Let's talk about what the market was actually paying for. December 2024. CAVA hits $150 per share. Forward PE ratio north of 70. Here's what that number actually means.
The opening for fast casual became really pretty obvious in the early 90s when you saw fast food not really able to get above the quality price barrier. They were kind of like locked into $5.
If CAVA earned $1 per share, investors were paying $70 today for each dollar of annual profit. To justify that price without the stock collapsing, earnings would need to compound at 20 to 25% annually for the better part of a decade. Not one breakout year, 10 consecutive years. That level of sustained growth is rare even in asset-light software businesses. In capital-intensive restaurant models, history shows it's difficult to maintain over full cycles. For context, Chipotle traded at 40 times earnings, McDonald's at 25. The market was pricing CAVA to conquer every suburb in America, maintain margins most operators dream about, and do it while selling perishable food scooped by hourly workers. Here's what Wall Street keeps forgetting about restaurants. A software company writes code once and sells it 1 million times. A restaurant buys chicken every Monday. signs a 10-year lease in a strip mall, begs a 22-year-old to show up for lunch shift. Every dollar of revenue requires physical effort. There is no copy-paste in the restaurant business. Yet investors valued CAVA like the hummus made itself, and the rent was optional. The numbers tell the story. CAVA averaged $3 million per location in annual sales. Sounds impressive until you do the math. At roughly 20% restaurant-level margins, that's $600,000 in profit per store before corporate overhead, taxes, and new store build-out costs. The market valued each location at nearly $30 million, 50 times store-level profit. That's not pricing in growth, it's pricing in perfection for a decade. At peak, CAVA's enterprise value traded at an EBITDA multiple far above traditional restaurant operators.
CAVA shares down lower this morning after the fast casual chain reported second quarter revenue and same-store sales that missed estimates. The company also trimming its sales outlook for the year as it tries to top last year's very strong numbers when it added grilled steak to the menu. And joining us right now is Brett Schulman.
But there's a critical difference between opening restaurants and filling them. Building a box is a construction problem. Throw money at it. Filling that box every day at noon is a human behavior problem. And human behavior doesn't scale on a spreadsheet. The fundamentals were real. 3 million in unit volumes, millions of loyalty members, new locations performing at or above projections. These weren't fake numbers, but real numbers can't support fantasy valuations. And outside CAVA's four walls, something was shifting. Something Wall Street hadn't priced in yet. Something that would make 70 times earnings look delusional. The collapse of CAVA's growth story wasn't caused by bad food or bad management. It was caused by a shift so gradual that by the time anyone noticed, the damage was done. Picture the core CAVA customer, 25 to 35, major metro area, office job, or hybrid, which means she's near a CAVA 3 days a week instead of 5. For years, spending $16 on a grain bowl felt like an investment in herself. Healthy eating, self-care. A treat that didn't feel like a treat because it came wrapped in the language of wellness. Then the walls closed in. Rent jumped. Student loan payments restarted. Grocery prices stabilized, but restaurant prices kept climbing. Government data showed food away from home rising faster than groceries throughout 2024 and 2025. Suddenly, that $16 bowl was competing with $10 meal prep from Trader Joe's. It was competing with Chili's, where $15 bought an appetizer, entree, drink, and an actual seat. It was competing with the grocery store deli counter, where Mediterranean bowls now sold for $8. The traffic data was savage. Restaurant visits cratered in 2025, but the pain split unevenly, what economists called the K-shaped recovery. The wealthy? Fine, still eating at CAVA. But the cultural engine of the brand, young professionals, the Instagram crowd, the people who made grain bowls a lifestyle, faced budget pressure. When discretionary income tightens, the first cuts come from habitual spending, daily coffee runs, subscription services, and yes, $16 lunches. Here's the part that shocked management. It wasn't just lower-income households. Middle-income segments pulled back too. Spending growth slowed across multiple brackets. The pattern was clear. Consumers were becoming more selective about where their lunch dollars went. Mid-August 2025, CAVA lowered its full-year same-store sales growth for the first time since going public. Revenue missed forecasts. The stock dropped 17% in a day. For a company priced for perfection, the stumble was catastrophic. This is the part where management had a choice, and they chose wrong. By mid-2025, the restaurant industry was in a full-blown value war. Chili's, 3 items for $10.99. Applebee's, 2 entrees for $25. Chipotle, loyalty rewards and app-only deals. Even upscale chains started offering weekday lunch specials. Industry-wide traffic declined year over year according to multiple third-party trackers. Fast casual underperformed both quick service and full-service dining in key suburban markets. Meanwhile, discount-heavy chains saw relative traffic stabilization, even as margins compressed. The signal was clear: consumers were trading down. Food costs remained elevated versus pre-2020 baselines, and labor inflation continued pressuring unit economics. In that environment, refusing to adjust price perception became a strategic bet, not a neutral stance. Everyone was fighting for the same shrinking pool of customers. Everyone except CAVA. CEO Brett Schulman drew a line in the sand. No discounts, no value meals, no chasing short-term traffic at the expense of brand integrity. He called it pricing discipline. He said they wouldn't get trapped in a race to the bottom, the kind that destroyed other chains once customers learned to wait for deals. On paper, he was right. Discounting can become a death spiral. Train your customers to expect promotions and they'll never pay full price again. Schulman had watched it happen, but here's what he missed. A selective value strategy didn't have to mean full capitulation. CAVA could have introduced a lunch-only value bowl. Simplified menu, fewer premium add-ons, priced at $11 or $12. Limited time, weekdays only. Keep the core menu at full price. Protect the brand while acknowledging reality. Panera did exactly this with their You Pick Two value platform. Chipotle tested cheaper burrito bowls for delivery. Even Sweetgreen quietly adjusted portion sizes and introduced lower-priced seasonal options. But CAVA didn't budge. When Chili's offers a full sit-down meal for less than your grain bowl, holding the line isn't brand protection. It's watching your customers walk across the parking lot. When grocery stores sell Mediterranean bowls for half your price, pricing discipline isn't strategy. It's denial. The refusal to discount looked like strength at $150 per share. At $60, it looked like stubbornness. CAVA believed its customers were loyal to the brand. But in 2025, they were loyal to the budget. And the budget won. November 2025, CAVA cut its same-store sales outlook for the second time. The stock tanked in after-hours trading. There was no floor, just a company slowly adjusting its expectations to match a reality it had spent months denying. The question investors started asking, was management principled or just inflexible? There's a layer to this story that goes beyond economics. It's cultural. For years, CAVA was the cool office lunch. It signaled you were health-conscious, adventurous, upscale, but not obnoxious about it. By 2025, the format itself had commoditized. Build-your-own bowls weren't innovative anymore. They were everywhere. When every brand offers the same assembly line with minor flavor variations, differentiation collapses. And when differentiation collapses, pricing power follows. Business writers called it slop bowl fatigue. CAVA, Sweetgreen, Chipotle, the Mediterranean spot on the corner, the poke place next door, they all blurred into one endless rotation of stuff in a bowl. When your format becomes generic, your pricing power evaporates. You're no longer selling a unique experience. You're selling a commodity. And commodities compete on price. Which brings us back to CAVA's refusal to compete on price. They were losing differentiation and refusing to acknowledge it. But there was a subtler shift too. The bowl became a symbol of the corporate grind, the sad desk lunch you eat between Zoom calls while pretending it counts as self-care. Once that association takes hold, the cool factor doesn't just fade, it inverts. The brand becomes the thing you're escaping, not reaching for. Fast casual traffic cratered in 2025. The gap between premium bowl chains and traditional restaurants, the gap that justified CAVA's valuation, narrowed to nothing. For investors who bet on cool staying cool, the reversal was brutal. Let's be clear about what this isn't. CAVA is not going bankrupt. The company is still profitable, still opening restaurants, still rolling out menu innovations, new locations are performing well. They have a real brand, real customers, and food people genuinely enjoy. But the question the market is asking now, the one that should have been asked at $150, is simple. What is a restaurant company actually worth? Strip away the narrative and you're left with cash flow. At peak pricing, CAVA's implied free cash flow yield was razor thin, meaning investors were accepting minimal present returns in exchange for distant expansion promises. That's a venture capital bet placed on a burrito line. Historically, even best-in-class restaurant operators have not sustained technology-style valuation multiples across full economic cycles. A restaurant company buys perishable ingredients every week, pays hourly wages, signs 10-year leases, and depends on millions of individual humans deciding what to eat for lunch on any given Tuesday. The distance between a tech multiple and a restaurant multiple is where billions in shareholder value evaporated. The lesson extends beyond CAVA. An entire category of dining grew up in a world of low interest rates, stimulus checks, and a cultural moment that celebrated paying more for better food. That world is gone. The consumer who powered it isn't dead, they're just counting. And when people count at lunch, the $16 bowl gets cut first. Did Wall Street fall in love with a business or with an aesthetic? What's left is a restaurant, a good one, with great dips. But great dips and a great investment have never been the same thing. And 2025 was just the market, painfully and expensively learning the difference. So here's my question for you. What other growth stories are really just expensive lunch? Drop a comment. What's the next CAVA? What company is Wall Street overvaluing right now because the story sounds better than the math? If you want more deep dives on companies where the hype doesn't match reality, subscribe. New breakdowns every week.